So today we're looking at Unit 3, just that review. And again, just a reminder, I have the third exam in front of me, or potential questions for the third exam in front of me. So my notes are what you can see. And also remember, another good tool is the review center found in Blackboard. So when we started this unit, we first introduced money, right? And the first question we have is, what would we do in a world without it? And we saw that without money, we have what's called a barter system. And with the barter system, what we do is instead of trading goods for money, we trade goods for other goods. Right? So if I trade you my phone for a computer, then we're trading two goods. We're not dealing with money or the traditional sense of money. So when we think about what money does, so the purpose of money is going to be, and we see challenges with that, with the barter system, in that we have what's called a. Let me take this a little step further. So we have this challenge with the barter system where we have to trade goods for other goods, and this requires what's called a double coincidence of wants. And basically, the idea of this is we both have to have something that the other party wants. So the only way that the trade for my phone for your computer is going to work is if you have a computer and you need a phone, and if I have a phone and I need a computer. If that doesn't work out, this barter system will not work out. So when we think about our purpose of money, we saw four main purposes. One was a medium of exchange. That is, I can use my money to buy goods and services, and I can use my money to get paid for goods and services that I complete. The second thing we had was a store of value. And the idea of this is that if I have money today, I can spend it tomorrow, or I can wait to use it in the future. So we have a retirement account. You have savings. Maybe you have a, a bunch of savings accounts. The idea again of this is I want to be able to use my money in the future. I don't just want to say, oh, well, I have it today and it has to be used by tomorrow, right? We want to be able to use it for the future and hold on to it. We also had it as a unit of account. And what a unit of account basically tells us is that money can be used as kind of like a standard of value. So we kind of have expectations about, well, this is what certain items are worth. If I said that there was a bottle of Coke for $10, it would you'd think of that as being expensive. But similarly, if I said you go buy a car for $10, you're gonna think of that as not being very expensive. Then the last big purpose of money is it's a standard of deferred payment. Oops. There you go, that's better. So the standard of deferred payment, where again, I can come in and the idea of this is I can, if I go out today and my car breaks down or my car is just blows up or whatever happens, I can go out and buy a new car, but I don't have to have all the money for a new car right now. Instead, I can buy it and then pay for it over time, or I can pay for it over time with a loan. So we're able to basically borrow from our future earnings. So after we introduced money, looked at what it is, we got into the question of how much money is there. And for this, the real question was, what kind of money do we have? So we had our M1 currency, which included or M1 money, which included our currency, our demand deposits, And these demand deposits were things like checking accounts, primarily checking accounts, money that I can access on demand. So we have currency, demand deposits, and our traveler's checks or a certified check. And the idea of the traveler's check again is something where the the money has already been paid for. That is, the money has already been taken out of your account, and the bank certifies that that money is there. The second type we had was our M2, and this would have been our M1 currency plus, and do note that this is M1 plus some stuff. So this would include our savings, potential money market funds, and CDs or cash and deposits. And those are the three main products. There may be some other less popular tools that we have, or excuse me, less popular financial products that we have for this, but that's pretty much what they are. So to find all these again, add everything together. So for M1, I should say this is currency plus demand deposits plus traveler's checks. I should say that M2 is the M1 plus their savings plus money markets plus CDs. The other thing that these CDs might be called are something like time deposits. So just another way to think about that, and so on. So we have this money, and we say we need it for all these purposes, but now we need someone to kind of handle our money, right? So I don't want to have to carry around. I don't want to have to carry around all of my money with me all the time. So we have our banks. And our banks, they're going to be what are called, they're going to act as what we call they're going to act as what we call financial intermediaries. And basically what this means is that they are a link between buyers and sellers. And banks do us a nice service. So the purpose of them, first we think the purpose of them is when they're linking buyers and sellers, right? That's one point. But they also act as a medium. They also act to help facilitate the movement of money. Right. That is, I can go to right now. Excuse me. So if I go out and I buy something using my credit card, whether that be online, or I use my debit card, credit card online, or just not even online, but in general, the bank is going to say, hey, I can go out, I can use my debit card. I don't have to carry, so if I'm going out to buy a $100 product, I don't have to carry $100 on me all the time. Instead, I use my debit card, and the bank will move that money to the vendor's account for me. So they help facilitate that movement. Similarly, if I write a check, so if I write you a check for whatever I'm writing you a check for, you're going to go cash the check, and your bank's going to go back to my bank and say, hey, our customer said that one of your customers gave authorization for us to put some of their money into one of our customers' accounts, and the banks will move that money for us. But the main thing that we're looking at is financial intermediaries. That was the main part that we looked at. So when you think of what they do, kind of their couple things they do or the big overarching theme, is they're going to lower our transaction costs. So if we think about loans, if we didn't have a bank or these financial intermediaries, and I have money left over at the end of the month, or I have leftover money, right? I need to find somewhere to send that money. Now, if we didn't have a bank, I could go around and I can start asking people, hey, can I loan out some money? Can I loan out some money to you? And so on, right? And And then we'd have to go out, find people to loan money to, and then I'd have to deal with collecting interest on it and collecting that back. And it's kind of a inconvenience, I guess you might say. So we have these lower transaction costs, but also if I'm looking to borrow money, I can, instead of having to go around and asking everybody in the world for money, I can just go to the bank and say, hey, I need $15,000 for a new car. Can you help me out? Right? And they'll say, sure. Here's 15. Meaning they probably won't give me the 15 grand, but they'll give it to the manufacturer, and they'll say, all right, here's your 15 grand. You can go and um, go out, buy your car. I go out, buy my car. They give the money to the manufacturer. I get the car, and then I pay them back. So I don't have to go out and find people to borrow money from. Instead, I know that, hey, if I need to borrow money, I can go to the bank, and hopefully I can get approved for a loan. So there's intermediaries, right? And they use your deposits to lend out money to other people. But one of the concerns that this can raise is an issue of a bank going closed. So what we run into is some challenges for banks. And they have a few, they have some short run and some long-term assets, or some long-term challenges. One of the issues that they face is called the asset liability time mismatch. And basically what this says is that assets can be removed right. So let's rephrase this. Customers can withdraw funds very easily. Can withdraw funds in a short period of time. And when our consumers, they go out to get their funds, they expect them to be there, right? So I expect if I go to the bank and I go to get some money and I have that much money in my account, I'm going to say, hey, if I want money, I can go to the bank and I can get the money, right? If you're coming up and you're going to pay rent or whatever the case is, you expect that, hey, when I write this check for rent, or if I go pick up cash, however you take care of your own rent, if I go out and I get my rent money, I expect that the bank is going to have it and I can do what I need to do with it, right? So customers can withdraw funds in a short period of time, but our loans can only be recovered in the long term. So if I have a loan, right, it's the bank can't really just come in and say, "Hey, you have to pay." Now, granted, if I was doing something that was kind of out there, something really silly, maybe the bank could. But on a regular day, the bank can't just show up my house, say, "Hey, we have a $10,000 loan for you. It's time to pay up." Right? In general, there's a policy to be able to do that, and for the most part, I'd say, well, we signed an agreement that this is when it gets repaid. So I'm going to repay it on that schedule, right? So the issue that banks face with this is, again, I can go out, pull all my money out today, but then the bank might have loans that don't work out or whatever the case is. So asset liability time mismatches, and another thing the bank could run into is the issue of bank runs. And this is, again, where everyone goes and gets their money out of the bank. So these are the challenges they face, kind of I don't want to say practical, but the application side of the challenges. The other things that we see, and what these will kind of lead to, is the potential for what's called insolvency. And this basically means that a bank that our bank will actually have negative net worth. And with this insolvency, this could lead to bankruptcy for the bank, which would be bad. Um, but they're insolvent. This means that their assets, meaning everything outside of their net worth, their assets are great. Excuse me, their liabilities are greater than their assets, so they are not able to repay everybody that they owe. So this insolvency, it's really not where banks want to be. It's not really a good time for them. But to alleviate, so we might say to reduce our risk, banks can we can have we can diversify our portfolio. So banks, instead of going out and investing only in mortgages or only in auto loans or only in personal loans, they'll do some mortgages, some auto, some personal, some business, and even within their business, instead of just saying we only invest in restaurants, they may also invest in hardware stores, restaurants, cleaners, barbers, all that fun stuff. So they can diversify their portfolio. The second thing they can do is keep a high is to raise their reserve ratio. Um, so instead of so reserve ratio, again, this is the percentage of deposits the banks have to keep on hand. So if a bank keeps more in reserves, that's less money that's less money that can be lost. Um, so they can raise the reserve ratio, and the third thing they can do is they can sell loans to other banks. So I can go out right now and get a mortgage from, say, Vision Bank, and then Vision Bank could take my loan and sell it to US Bank and say, "Hey, we got this loan for you, this mortgage for you, and this is the interest rate. Kevin will pay you back over the next 15 or 30 years, but you pay us for it now, and you get the loan over time." And if they sell that loan, that again is going to be money that comes directly into them or into the bank that sold the loan, which is again more secure than the loan itself. So one of the things we looked at in this was our reserve ratio. Okay. And if you remember, our reserve ratio is equal to our reserves divided by our deposits. And with this, what we got into is this thing called the money multiplier. And what this had us do is it had us take, and what this really looked at is how much money gets created in a banking system with different, in a banking system with a given reserve requirement. This is something we're kind of seeing and hearing about right now in the news more than normal, or more than I normally see it. So we see people aren't working right now. So we're like, well, how can we get more people? How can we kind of keep the economy rolling even though times are slow? We're saying, how can we keep the economy rolling? And one way to do that is, at the time of this recording, there could be some news coming out fairly soon. But I'm going to suppose that we're still in the middle of everything. So we want to know, how can we keep the economy rolling? And to do this, we can get money in people's hands, because if people can keep money in, they can keep paying rent, they can keep paying bills, and they're not going to get foreclosed or evicted or anything like that, save any laws that would prohibit that right now anyway. But when we look at our money multiplier, as we say that our money multiplier is equal to 1 over our reserve requirement, where a 10% reserve requirement is equal to 0.10. So if we had a reserve requirement equal to, say, 15% or 0.15, then our money multiplier would be equal to 1 over 0.15, which comes out to 1 over 0.15, which comes out to 6.67. So what this means, if I have $100 and I put it into this, banking system that has this 15% reserve requirement, that $100 is going to turn into $667 of money. So that's what we're looking at here and how that works. So if we took this a step further, we said again, suppose that our initial deposit is equal to, say, $500. Then the change in money supply will be equal to our deposit times our money multiplier. So we take that 500, multiply this by 6.67, and this gives us 500 times 6.67 gives us about $3,335. Yep, cool. So that's how we go about that kind of problem if you see it, and you see how much money is created by the system. So after this, we said, cool, we can create money, and that's kind of where we got through with our more theoretical part of that part. But the next thing we got into was looking at diving into our financial system, our monetary system. And with this, we talked about the central bank and the Federal Reserve. So we introduced the central bank. And this is basically the institution that more or less manages a country's monetary system. And we said in the US, this is the Federal Reserve. And if we think about the structure of the Federal Reserve, we can notice a couple things and look over, I'm just going to say look over the structure. But keep in mind there are 12 regional banks. And see if there's anything else we want to throw in about them. And it is its central group, or its central, I guess its central authority is called the Board of Governors. And the Board of Governors is going to have 7 members, including the chairman, the chair. So that's our central bank. Kind of a little intro to our central bank and the Federal Reserve, and kind of re-walks over, what they do and what they are. So, what the big goal of them is going to be to stabilize the monetary system, or stabilize our monetary or financial system. And I focus more on the monetary because they more are going to focus on the on things like inflation and the value of our dollar, but it does sort of carry over into our financial system as well. But when we do this, one of the things that they do is, so if we look back at the issues, one of the issues was that they had was this issue of bank runs. So they want to prevent bank runs and promote the stability of the and promote stability. So to do this, one of the things we did was they created the FDIC, which is basically deposit, not basically, this is what it is. It's a deposit insurance on your accounts. So if I go put my money in the bank, right, say put my money in US Bank, and then tomorrow US Bank folds or they close. FDIC, they have deposit insurance, so my deposit will still be there. My deposit's not just going to go away because the bank closed. So we have deposit insurance, and you're insured up to $250,000. Cool. And then what we got into with, uh, and then to actually, so they have this first thing that stabilizes, but the second is, so that's kind of their first goal. The second goal is to, ooh, that's confusing. Let's give that an A. So our second goal is going to be to conduct monetary policy. And one of the big things with our monetary policy that we saw was what's called open market operations. And basically what we do is the Fed will basically, we'll say trades money and bonds with banks. Right. And there are kind of two things that can happen. We can either increase or decrease the money supply. So we had what's called expansionary policy. Which is, again, going to increase the money supply. And the tools the Federal Reserve had to do this is they can lower your reserve requirement. Because if you have a lower reserve requirement, then there is more money that can be loaned out. The second thing they can do is lower the discount rate. And the discount rate, again, this is the rate at which the Federal Reserve makes loans to the commercial banks. And the third thing that they, or kind of the third thing they can do is they can purchase bonds from the bank. And when they purchase bonds, this again adds money to the bank. So what this looks like, what this little process here is, we have the Fed, then we have our commercial banks. If we have expansionary policy, the Federal Reserve is putting money into the banks, and the banks are giving up those treasury bonds back to the Federal Reserve or U.S. government securities, whatever it is that we're interested in. The other type of policy we have is called, yeah, that's good. The other type of policy we have is called contractionary policy. And with contractionary policy, what we're going to see the Federal Reserve is going to do is ultimately they're going to decrease the money supply. And basically, they can pretty much do the opposite of up here. So I'm going to cheat a little bit and copy and do a copy and paste up here. Okay. So we can copy and paste that and see where we end up. I guess we're not copy and pasting that. I guess it's not even going to copy. Okay. So we'll just write that out. Am I picking up something? Oh well. Oh well. So we have contractionary policy. Again, the three things we can do with this is A, we can increase our reserve ratio. B, we can decrease our, excuse me, we can increase, I said that right? Yeah. We can raise our discount rate. And basically what these both amount to is we are going to sell bonds to the banks. So what this will look like is, again, if we have the Fed and our commercial banks, the Federal Reserve will sell bonds to the banks and they will pull back money out of the system, thus making it harder to make loans and kind of slowing the economy down a little bit. So we have all that. And that's really what we looked at with the Federal Reserve and the policies that they have. So after this, we got into um, we got into a pretty we got into the we got into exchange rates and international capital flows, but mainly exchange rates. And with our exchange rates, a few things we looked at was yes. So we thought about exchange rates and again these international flows. We looked at who participates in this market and why would there be money flowing around. One of the things we looked into is who's playing in this market, and we got into a talk of foreign investments. And with our foreign investments, we had two types of investments we can make. The first was called direct investment. And this is where we actually invest in a company, invest or create a company with the intention of actually excuse me, with the intention of like actually managing the company. So what some firms do, a lot of our firms that are trading internationally and that have a presence in the global market, what they'll do is they'll make a subsidiary of themselves in the UK or in Japan. So you'll have something like McDonald's of Asia, McDonald's of Europe, whatever their subsidiaries are. And then McDonald's will actually manage that subsidiary. So they have a separate company, but they're managed by the home company. The second type of investment that we'll see is called a portfolio investment. And with our portfolio investments, what we'll see is that we invest with no intention of managing. And if any of us actually, invest in the stock market or anything like that, most of us would be investing purely for financial reasons, right? That is, we're coming in and we're going to say, well, if I invest in this company, I'm going to see an increase in my portfolio. I'm going to see myself have more money. So we have these two type of investments. But one of the things that can come up with investments is things can go wrong. So what we get into, so we want to kind of protect ourselves from if something goes wrong or whatever the case is. So what we have is what's called hedging. And this is going to be a financial, basically a financial safeguard. So I'm going to purchase this product that's going to come in and kick in when things go bad with my other products. An example of this would be something, and in our regular lives, an example of this would be something like insurance. Right? So you have auto insurance, so that if you wreck your car or you hit somebody with your car, your insurance will pay out rather than you having to pay out. With this auto insurance, the idea is, again, if I hit somebody and they get injured, I don't have $100,000 to pay their hospital bills, so my insurance will pick in and say, hey, I pay this insurance every month, 6 months, year, whatever the case is for you, and excuse me. And when I pay this insurance, they're going to kick in and help out when something goes wrong. So we have our hedging, which is pretty cool. So when we think about the foreign exchange market itself and who demands and wants currency. So what I'm going to encourage you to do for this part is look over the slides about who benefits and harms, who benefits and hurts from appreciating or depreciating currency. As well as participants in the foreign exchange market. And I'm going to leave those two for y'all to kind of look over, just because they're just lists pretty much, and I don't know, something you can just look up and see fairly straightforward. And then when we think about what is the exchange rate is based off demand and supply for that currency. So I think you're on that front. But the last thing and the interesting thing what I think is the most interesting part about this part and that we have going on is kind of two things. The first is called arbitrage. And what arbitrage is that it's kind of this thing that happens where I can buy a good in one country cheaply, then take advantage of the exchange rate, then sell it in another country at a higher price. And with arbitrage, normally we'd be taking advantage of exchange rate, some differences in the exchange rate. So maybe it's cheap to live in some countries, more expensive than others. One of the travelers I watched on YouTube recently went to Bulgaria, or recently I got to their videos on Bulgaria, and they were commenting on how incredibly cheap it is to be in that country, right? So what they could do is they could come in and buy some goods there, and then bring them back over here, take them back up to the UK, or I think he's from the UK, or take it to a more of a higher price country, we might just say, and sell those goods. So the issue that comes up with this, again, we have this, so what we're interested in is not just our exchange rates, but we're interested in this idea or this rate that's going to be our purchasing power parity. And what purchasing power parity is going to tell us is this is going to be an exchange rate where basically our purchasing power is preserved. So what we'll do with this is we'll take so if we have, say, the price of gas in pounds is, say, 1.40 a gallon, and the price of gas in dollars is, say, 1.62 a gallon. If we have purchasing power with parity, what we'll do is we'll say that the price of gas in pounds will be equal to the exchange rate for PPP times the price of gas in dollars. So this means that 140 is equal to the exchange rate in purchasing power parity times 1.62. And this will give us that the exchange rate from dollars to pounds would be equal to 1.40 over 1.62, which is somewhere between 0.8 and 0.9, which is 0.86. So this means that $1, if we have purchasing power parity, $1 should be able to get me 86 pence in terms of the pounds. And I should make that a little more clear that that is a pound. And what we're going to use this for, so we say, yeah, this tells us what we can, this tells us what we can do, but the big purposes that we see of this is going to be, it's going to help compare international GDP, or it'll help compare international statistics. So in the real world, right, we don't necessarily have this. The reason that we don't always have PPP or purchasing power parity is because different areas have different costs. Even if we think about just within the United States, the cost of living between Iowa and New York are completely New York City are completely different costs, and what we consider expensive and what they consider expensive are, two kind of completely different things going on. And the other nice purpose of this is going to help compare exchange rates. So it'll be able to tell us, is a certain dollar over, undervalued, or what case do we have? So an issue that we have with our exchange market is we want to have control. As a country, we like to have control over our own money. So what we want to do is we potentially want to reduce how much people are, we want to be able to kind of control the exchange rates. And to do this, we introduce what are called Tobin taxes. And this will be a tax on, this will be a tax on basically money leaving the country. Leaving or entering the country. And again, the goal of this is going to be to limit or reduce the movements, limit our, I want to phrase this as international financial, we want to limit our international financial capital inflows and outflows. And for the most part with the Tobin tax, we see as, we're not too worried about it so if you're going out of the country, you're taking a trip to Europe and you have $500 cash on you to make that happen, just kind of as in case something goes wrong with the credit cards or in case you need cash. You have this $500 cash, more than likely, and actually they won't, customs isn't going to care because that's not really, you're not doing that to like evade taxes here. You're doing it for a small time deal and so on. However, if you do come back into the country, One of the things that customs will ask you is they'll ask you if you're carrying more than $10,000 cash. I think it's 10,000. So if you're carrying more than 10,000 cash, they want to tax you on it. You have to pay that tax on it. If you have less than it, they're not super concerned about it. So we have those Tobin taxes, again, trying to limit the money going in and out of our own country. So after our capital flows, we got into a talk about fiscal policy. And we talked about government budgets. So the first bit of this we introduced was looking at the government budgets, and we had kind of we had this thing going on, and we talked about kind of 3 states of the government, or 3 states of the government budget. We can either have a budget deficit, and this means that our expenses, or I should say our spending, is greater than our revenue. That is, we spend more than we bring in. The second case we have is called a budget surplus. And this means just the opposite, that our revenue is greater than our spending. And the third condition we can have is a balanced budget. And as you can probably imagine, which, I mean, we know because we covered this a couple weeks ago, but this will mean that our revenue is equal to our spending. Then we got into a little bit of talk about taxes and all that stuff. So we talked about taxes, federal tax. I'm going to leave these for you since it's already 3:50. The federal tax sources, we might say, so things like income, corporate, etc. You'll just want to know what they are, be comfortable with them. So we have our sources of federal tax revenue. Then we talked about some different tax rates. So you'll want to be comfortable with. That is, know what they are. The marginal tax rate. Oops. We have a marginal tax rate, a progressive tax, a proportional tax, and a regressive tax. And if there's anything that we go kind of quickly over this where I say, hey, be comfortable with these and move on, if when we're done you want to come back and see those and go more in depth, we can. I can stick around after 4:15. But I just want to make sure we get through everything before we do and go into more in depth into certain things. So we have our tax systems and different types of taxes, but the next thing we kind of looked at was, we might call it, types of fiscal policy. And we're into 2 main types. The first being expansionary. And for fiscal policy, expansionary is going to be that which boosts our aggregate demand. Then we had contractionary. Let's give a little extra space. So then we had contractionary. And this is going to more or less work to shrink our aggregate demand some. So with expansionary, what we're looking at is some combination of an increase in government spending or a decrease in taxes. Then for contractionary, we're looking for some sort of decrease in government spending or an increase in taxes. And remember that we treat these as two separate things, right? So just because the government spends more money doesn't necessarily mean that they're going to change the tax code this year and to reflect that. And similarly, just because we raise taxes or lower taxes doesn't mean they have to adjust the budget or their spending out front. So last month they passed the stimulus package. It was a month, almost right around a month ago today, actually. They passed the stimulus package, and it was a huge increase in government spending. But when they passed that, it did not affect your 2020 tax code, right? So the taxes for 2020 are the same with or without the stimulus package. Now for 2021, it might be different, but that's down the road a little bit. But we have these combinations, our types, and what we see with our types of policy. So the other types of, so we also had methods of enacting policy. I guess, for lack of a better phrase, methods of actually enacting this policy. So the first thing we introduced was our discretionary policy. And discretionary policy is that which is voted on by Congress and takes effect through a law or through a law, pretty much. So in the case of the stimulus package, that was discretionary spending. The government said, "Hey, we need to, pump money into the system." So, oops, not that. So the government said, "Hey, we need to pump some money into the system." So they passed that stimulus package, went through the House, the Senate, and then made its way and got signed and became law. But the other side of this that we have is called an automatic stabilizer. And this is going to be a program or something that increases spending when times are bad and it decreases when times are good. So our examples of an automatic stabilizer would be things like unemployment, food stamps, and so on, or EBT, whatever the stamp benefits, whatever the phrase for it is today. So your automatic stabilizer, again, when times are bad, more people get to draw unemployment, which raises that spending. If you do go to apply for unemployment, it's not something that goes through the House and the Senate, or it doesn't go through the Iowa House or anything like that. It just, if you apply and you're eligible, you get it. If you're not eligible, you don't get it. And it's fairly, and granted, I know it's more complicated than how I'm making it, but that's kind of the basic understanding of how these automatic stabilizers work. So the issue with our fiscal policy, so the big issue with fiscal policy that we're going to see is going to be lags. And we talked about 3 of them. We talked about a recognition lag, a legislative lag, and a implementation lag. And each of these are really what they sound like they are. Let me rewrite that way it comes in a little nicer. So with the recognition lag, we have to realize that there is a problem. the legislative lag, the funding. I'll also say funding has to get through Congress and the president. And then the implementation lag means that it takes time for money to for the funds to get to where they need to go. So when we think about like the issue with the coronavirus, when we think about the recognition, it took us time to realize, hey, there's a virus, and hey, it's actually like a real thing that we need to be thinking about. We had the legislative. It took time for the CARES Act to get from the House to the Senate to the president, and then for implementation, it takes time for the stimulus checks to actually get out to the people. The IRS has posted a schedule. They said, hey, if you have, I think tomorrow they have all their direct deposits taken care of, but then after that they're going to start rolling the checks out. So starting next week, I think if you're in that lowest income bracket, you get checks first. The second bracket will be 2 weeks, third 3 weeks, so on and so on. So you have the implementation lag, and these put together can potentially cause issues with our fiscal policy. And then we got into our talk about a balanced budget. And with this, I'm really just going to say is to be comfortable. By be comfortable, we can also say have handy the pros and cons. So basically, the advantage of a balanced budget is going to be it's going to keep our debt in line. It's going to keep everything kind of where it needs to be. The disadvantages of it is it's not flexible. So in times of a recession, a lot of people are going to jump on unemployment. And if we just take this one little thing as an example, people jump on unemployment, and when they do that, they increase government spending. If we have a balanced budget amendment, this is going to be hard to do, because if they increase spending, that means that something has to go to replace that. So it's nice to have the flexibility. The other issue that they mentioned in the text was something about investing. So if I have to have a run a balanced budget, I can't really make an investment in something, whether it be education, roads, whatever the case is, because again, I don't have that flexibility to make that upfront payment, and then I can pay it off over time. And oftentimes, if we do invest in our country, we'll see that the investment will pay off more than the additional loan will charge in interest. So again, just look over those reasons for why we'd be for and against a balanced budget amendment, and that will get us through our fiscal policy. So the last little bit we looked at was comparative was international trade. And with international trade, we kind of, in a little way, went back to the beginning. But, oops, sorry about that. So with international trade, we first looked at absolute and comparative advantage. So comparative and absolute advantage. And basically what comparative advantage told us was that I can produce a good with a lower opportunity cost. While an absolute advantage said that I can produce a good using fewer resources. So opportunity cost is how much of the other good I have to give up. Those resources are just more of a raw Am I better at making a product than you, or are you better at making a product than me? So what we'll want to do is be able to compare. We'll want to be able to calculate that opportunity cost, I think, and determine comparative advantage. Oops. So a problem that could come up like this is that we'll say that the thing that can come up with like this is, suppose that Iowa can produce either 75 wheat or 100 corn. We might say, what is the opportunity cost of producing, say, 8 corn? So in this case, we want to figure out how much wheat do we have to give up to produce 8 corn. To figure this out, we can do it a couple ways. The easy way that I can think of is we can say the number of wheat divided by the number of corn we can produce will be equal to just that over here. So number of wheat over number of corn. So our opportunity cost of corn would be right here, because this is for 1 corn. So, or we can take this, then multiply it by the number of corn. Whatever we want to do, we can do. But we have that wheat, we can make 75 wheat or 100 corn. And this will be equal to some number of wheat divided by 8 corn. 75 or 100 is 0.75. Then we can multiply that by 8. If we multiply 8 by both sides, then we get that 0.75 times 8 is 6. So in this case, the opportunity cost, so in this case, 6 wheat is the opportunity cost to produce 8 corn. So if you see something like that, that's basically how you can do it. And the last little bit, you want to look over and it's more of an in-depth example that takes a little bit of time to do, but look over the gains from trade example. And what you'll see with that is it brought us in and it got us, so if this is our PPF, and suppose that we initially produce here, with trade, we have the ability to produce somewhere outside of our production. Excuse me. We have the ability to consume somewhere outside the PPF, which is like really cool to be able to do. And with that, you should be comfortable with that third unit. So that's where I'll end this video.